Islands, I see. New York by way of Houston. Fantastic. All right, Nat, let's get to it.
1 second. Okay, so I'm going to share my screen.
All right, so let's just jump right into it. Next, you gonna pull up on that?
Yep. All right, here we go.
All right, so this is the reason we're here and what we did this series. Obviously, our mission is to help, broadly speaking, is to help 100,000 people of color become millionaires by 2030. The reason we're doing that is because obviously, and this has been said many times, I don't want to sound like a broken record here, but the fact of the matter is that there's 1.2, 1.3, as much as 1.4 trillion, according to some estimates, of consumer dollars that flows through minority communities, right? So in spite of that, there's a billion, according to some other stats, we can all agree that the number is vast. There is a gap of the wealth between people of color and everyone else that'll take literally over 200, and that I believe in the numbers more than 220 years to close. So that's our mission. That's why we're just here to share that and be of service in that way. So that's our mission. Can you pull up? Can you roll up that?
Yeah.
All right. And the number one driver, and there's been studies from McKinsey that back this up. There's even one number that says closing the wealth gap will increase the U.S. gross domestic product by 6%, which is unreal. Just from people of color becoming more cognizant, aware, and active in the in real estate ownership. All right. So again, number one driver behind the racial wealth gap is the absence of real estate ownership. So so now that we have that out the way, let's continue to why we're here today. So the theme of today's webinar is how to invest in real estate for $1,000 or less. Reason being, of course, there's a misconception that you need a lot of money essentially to get started in real estate, which isn't necessarily true. There's a number of ways. We want to dive into a couple. One is to buy into what's called real estate securities, which means bonds or stocks. And then, of course, investing in a way where you would be managing the asset yourself or with a group. Back to what we spoke about last week, which was how you use an FHA-backed mortgage to buy a property with only 3.5% down. And this is sort of an extension of that. So let's go down that. All right. So one of the things that, number one, before we start is that there are a lot of, make sure you ask questions, not make sure that if people have questions about this part, I really want to answer this. How investing generally works. There's a lot of misconceptions. One comment I saw in a video, which really is part of what inspires me and drives me to share this information, is that there's a lack of clarity and something that isn't taught in schools about how investments work. For instance, 8 to 10% return on any investment is an outstanding rate of return. But to a lot of people, which includes myself before I became aware, if you have $1,000, you get a 10% return. That's $100. It doesn't seem like a lot because when you put money out, a lot of times we've been conditioned to think that we can flip it or $1,000 should somehow become $10,000. And there's a number of things in society, so to speak, or just generally around us that don't factor in reality. That's simply not how money works. So, but again, in order to evaluate, and when you see investment opportunities, whether they are private equity opportunities, which basically means you're investing with a professional money manager who buys either companies, venture capital is a form of private equity. Then there are dividends, which is a form of capital distributions you get from an investment. And then there's interest, which is essentially what the bank pays you, is supposed to pay you, which they don't pay much of these days, whenever you put money into something. So there's different ways that money can make money for you, if that makes sense. And then lockup periods, which basically goes into when you have investments, you generally have two forms. One is called liquid investments, which is cash, stock, bonds, basically securities. Securities are cash. And then you have alternative investments, which is anything but that. That could be energy, that can be real estate, or it can be businesses. So things of that nature. And when you have illiquid or what's called alternative investments, the play there is your money is now locked up for a period of time. So what this means is you can't just go and cash it out, because the money manager is working that money over a certain period of time in order to get the spectacular returns. So when you invest in the stock market, for instance, or in cash or a bond, you get a fixed return, but the liquidity, meaning the ability to take your money into your investment and then turn that investment into cash, that takes away the ability of the money manager, whoever holds that money, to generate those strong long-term returns, which is why illiquid / alternative investments have much higher yields, and which is real estate alone is the largest asset class in the world. And that is largely an illiquid asset class, right? So that's why you can see a lot of high returns, which may look like low returns, but are really high. For instance, a 15% return doesn't seem like much, $100 and $15. Over a 4-year period, that's your money doubled. So with a 15% return, your money doubles in a 4-year period. So just keep this in mind. When you see those numbers that seem low, 4-year period, you get to double your money. And this is very common in real estate. So these are just some things to factor in. So I just wanted to preface these strategies with that. So some will be liquid, some will have a lockup period where they're illiquid, but they usually have higher returns. So when there are various tax benefits and tons of benefits you can get from investing in real estate in different ways, and that's a little more complex, and we could talk about that. That's something we can discuss another time, but for this here particularly, I just want to share with you guys how you can invest with $1,000 or less and have a sensible, I don't even like this word realistic, but a sensible, clear and sound approach and expectation when you go into something. Because a lot of times when you see dividends being paid out and you see this if you have $100 investment, it'll be a couple of cents. You're like, what is this? But like they say, pennies count, and keep this in mind, compound interest. A penny double per day for 30 days, look it up, will amount to millions. So now let's continue.
Can you actually talk a little bit more about dividends and the benefits? Someone in the chat room is asking.
Okay. All right. So returns, let's break down the terminology here. Returns just means, look, I'm investing in a company or a building, and I'm expecting to get a 20% return in a year. Let's say you invest $1,000 and you get a 20% return, and you're getting $200. Does it make sense? 20% of 1,000 is $200. All right, so that is how you describe returns. You can see it expressed in a number of ways. You can look at it as, and again, it could be a direct function of, okay, money in, money out. We call, without getting too jargony, they call that cash on cash returns, or your equity dividend rate is basically how money did you get out against how much money you put in. And you have something called the cap rate, which is the most basic term to use as a real estate investor. Again, we can jump into this some other time, which I believe we are when we're breaking down the terms that every investor should know next time. But returns is essentially a percentage of, you invest this much, this is how much you get out on a cash flow basis and on a value basis. Dividend specifically means when you invest with, and again, because of the pandemic, there's been a lot of, if I say something now, it could be inaccurate because a month or 2 months ago, companies were offering high dividends because of the chaotic state of affairs that we're currently embroiled in. But a dividend basically means if you invest, let's say $1,000, and they say we pay 5% dividends, then you can get 5% of that annually. Sometimes they may pay it out quarterly or even monthly or even annually. It all depends. But that's a dividend, meaning that you get paid back on a recurring basis on your investment. And then of course, interest is just like what you pay on your house or in your car note, or that's interest. So I hope that breaks it down well enough.
All right.
All right, let's get to it. Okay, all right. Billionaire blueprint, liquid investments versus illiquid investments. Again, I see a question here, dividend equals profits. Not necessarily. You can look at a dividend, is not the exact terminology, but let's say you invest in a bond. All right, you may have heard the term junk bond before. which means that you're buying in government. Bonds come in two forms: government or corporate, right? Typically. So a company may issue bonds where they say, look, you give us X amount of money, we're going to pay you an interest rate, because a bond is technically debt. Investments, well, they're all investments, but if you're a shareholder, that's equity, meaning that you own a piece of the company. If it's a bond, you're just issuing a loan along with other people against the business. So let's say you get paid 10% on a bond, right? There is the risk of default. Let's say they're not able to pay that 10%. That's where the risk comes in. The lower, like you see the treasury bonds, you pretty much trust the government to pay that money back, that they have the money that they're good for. So the risk is lower and therefore the yield is lower. Junk bonds have high yields because the risk is higher. So that's just something to keep in mind. So no, dividends don't necessarily mean profits. It just means that you're getting a percentage paid out against what you invested. Your principal meaning what you put in, and then what you get on a running basis. I hope that makes sense. So again, billionaire blueprint. The reason I call it the billionaire blueprint, number one, if you go look at the Forbes list and you see a large portion of their fortunes where they were built from real estate. The great thing about real estate or alternative investments just in general is that you can take, remember last week, you can take the cash you have and the bank will give you, and that will count as 3.5% of the total value. The bank will bring the rest. It's called leverage. So that's what any billionaire you see, by the way, are probably 70, 80% in debt. The reason they're in debt is because they use debt as an instrument to build wealth. As long as your cash flows, meaning the money comes in, can service that debt, you're in a good spot. But bad debt is a situation, not to get into consumer finance, but bad debt is like stuff that you have to, that's not making money for you. Anything that's not making money for you that you're using debt to get, like it could be even a car, unless you're renting that out somehow, but a car typically, or even a house that you live in, if it's not making money for you, then it can be considered bad debt. The reason I call it the billionaire blueprint is because with illiquid investments, by using leverage, you can literally turn 100 million into 500 million overnight. And if you're really adept, and a lot of these guys, they can get better financing terms. They can turn $100 million into $1 billion overnight. That's just what it is. So, all right. So I just want to bring that in there. So let's continue. All right, ready? Let's go. Let's do this. Haha. Man, this looks sweet. Jeez. Sweet. All right, let's get it. Okay, so investment strategy number one, REITs. REIT. It's an acronym that stands for, it's become part of personal finance, folklore, colloquial, daily, everyday speak. It just is, we pronounce it REIT. It stands for Real Estate Investment Trust. And what that is it's a company. It's essentially a landlord that has taken a company public. Now there are private REITs, and this is another discussion for another day, but REITs, they're publicly traded companies that own real estate, essentially. If you look at the, as a matter of fact, everybody pull out your phone, unless you're on your phone here, and just Google Empire State Realty Trust. That is the Empire State Building. That is the owner of it is the Empire State Building. And Google that with Yahoo Finance, and you'll see that it's, last I checked, it was $6, $7. So that's an example of how you can buy a piece of the Empire State Building literally for less than $10. That's an example. If you look at the building, you may recognize the building in the center, Madison Square Garden, iconic building, right? Everybody knows Madison Square Garden. That is owned by MSG, which is also a stock that you can buy, right? And then you have, let me move this over here. Then you have the New York by Gary. And $6.18 for the Empire State Building. Quick sidebar. One thing you must understand right now, the real estate industry, real estate is just like this large, all-encompassing term that represents an asset class. But there are a lot of different asset classes within real estate. You have office buildings, naturally they're suffering right now. Then you have retail. There's a reason why you see all these retailers go bankrupt. It's not that they're going out of business. It's just that they're locked into long-term leases and there's no foot traffic. So they have to file bankruptcy to get out of those leases, which hurts the landlord. So therefore retail buildings like malls, you can get them are very, very cheap. Then you have hospitality, which is hotels. Obviously right now there's a massive dip in travel. So hospitality naturally suffers. So this is why a lot of these prices are low. Now, but that aside, this is how you can buy a piece of these buildings for that little. In fact, if you use Robinhood or Stash, the reason I use that is they're the most popular ones. Robinhood is good if you want to go in and just find the stocks yourself. Stash has what's called, and we're going to mention this a little bit later in this presentation, has what's called ETFs and mutual funds, like basically baskets of companies. They pick the ones for you. You just pick one with a theme. So, but this is one way here, and one cool option that they have, and this actually translates to non-real estate stocks as well, is that they allow what's called fractional shares. Now, a few weeks ago, Apple just announced that they were doing what's called a stock split. So what's a stock split? Basically, the stock had gone to such high price, it had become so expensive that they slice it into pieces so it would allow more people to get in because it would be cheaper now. With fractional, which is really kind of redundant, but as if you're operating with a broker, like with your bank, and they have a brokerage account for you where they buy stocks, it just allows more people to get in, because who wants to pay $2,000 for a stock if you're just trying to get in $400? Doesn't make sense. Fractional shares allows you to buy a piece of a share. One saying, can you invest through Acorns? Yes, you can. There's a number of them. The reason I picked these two is because these are the popular ones and they have the fractional shares option. Acorns is a tremendous app for something else. We're just using these two because it's easy to utilize the strategy. We'll discuss it right now. Now, REITs. There's a number of them. You can, as a matter of fact, I think there's 200 and some in America right now. And you really can, if you dive in, it's really fascinating to see the type of iconic real estate projects that you can buy that's a part of REITs, and you'd be surprised. So again, New York by Gary, the one there with the, I don't know if you ever been in New York, this is downtown Manhattan, and you can see it is a very unique building. Obviously the Empire State Building, Madison Square Garden. So that's one example. With fractional shares, you can just put in $1 and you can just see how it goes. And what I would recommend, because remember, for me personally, when I go into an investment or any type of opportunity, I always factor in a 10 to 15% tuition tax, where if I do something new, as long as covered my downside as much as I humanly can, there's still going to be stuff I don't know that requires me to learn, which could slow down my productivity. So that's how I factor in 10 to 15%. The cool thing about doing it this way with this little money is that it's kind of like, what's the most crude analogy I can find? When we're children, we don't speak, we don't read, but we learn to speak. It just becomes a natural extension of what we do. Then we learn to read. It just sort of happens. When you buy these, a lot of these terminologies that you see, a lot of these terms and how these different instruments work, it just becomes second nature because you see it. And at $1, $10, it's not a bad way to learn. And then when it becomes second nature, then you become far more sophisticated, and then you can go make the big bets. But just as an entry point with a low barrier to entry, REITs is a tremendous way to get started in real estate. All right, any questions about REITs? Nope. All right, I'm seeing people are saying there's a ton of companies that have fractional shares. Cash App has fractional shares. I'm sure there's a lot of them that have this. Oh, tax benefits. All right, quick thing with REITs. Oh, there's one thing you guys got to consider. REITs, by law, in order to be a REIT, have to pay out 90% of their earnings in dividends. So that ensures that you will get dividends on your investment because they are by law required to. All right, makes sense? That's one of the things. They're actually by law required to pay dividends. And there's a number of them that are paying high dividends right now. Reason they do that is because a lot of them need liquidity to make sure they don't default on loans. So you want to make sure, because it's publicly traded, you go on the balance sheets, you see how much debt they have outstanding when it is due and things like this. And that's something we can probably discuss some other time in terms of how you really dive in and things of that nature. But one thing that you'll probably see is in the next 12 to 18 months, you may see a lot of office building foreclosures, but the big ones should be in good shape because they're run by sophisticated people with billions of dollars, and they'll find a way not to lose what's allowing them to have billions of dollars by hook or by crook. All right. So yes, dividends. they are by law required to pay dividends. So that's what's cool about this strategy. Let's continue. Good one. All right. This is an extension of the REITs, right? Mutual funds and ETFs are basically companies. They're money managers, and their job is to invest. They focus on a sector. It could be media, it could be technology, it could be biotech, it could be cannabis, it could be whatever. Then you have some that focus exclusively on real estate. And they're publicly traded as well. You can buy a piece of them, and they then go out and pick the best REITs. So they take the thinking out of the equation, allows you to get into real estate ownership without having to do much. You can just look at their history, how well have they performed, what are their dividend rates, and you can just go right in. Now, as you can see here, I picked 3 popular ones: iShares Core US REIT ETF. Then you have the Vanguard Real Estate ETF. This is the cost per share. So it's less than $1,000. And then you have the Schwab US REIT ETF. These are finance names that you may have seen before, which is why I included them.
Is Fundrise considered a REIT as well?
We'll get to that.
Okay.
We'll get to that. We'll get to that. So this here is, again, the mutual funds and the ETFs with fractional shares, right? With fractional shares, you can buy a piece of these. You can put $4, $5, whatever you want. I think with Stash, you can go as low as $0.01. So to be honest, and for some of you guys that may have the app, Robinhood or Stash, they're actually giving away free stock. So for any of you, if there's one of you guys that has that share link, you can put it in there. Whoever shares it gets a free stock. Whoever picks it up gets a free stock. So you guys will have made money on by tuning in today. So somebody that has that, click it. If you guys don't have any of the investment apps, I'm sure a lot of you do, but if you don't, do that. There's an easy way, and then you can use that. You can use that money to just go buy some of these just to test the waters. So that's one thing that I would recommend. You're totally protected from a downside standpoint. And but yes, this is an extension of the same thing. It's not a REIT, but it's a mutual fund / ETF, which is essentially a company that buys various REITs. You find mutual funds and ETFs in other sectors as well, like I said. But for real estate specifically, these are some. Investopedia has a lot of them. If you just Google it quickly, you'll find, if you just look at the reputable links, you'll see exactly which ones you can look into. And Yahoo Finance, they break it down very neatly. You can look over a 5-year period. How has it performed? How has it performed? You can see sort of what the baseline is. Even if they go like this, you can sort of see what's the median, the average, right? How did they react to the pandemic? Did they dip? Have they recovered? That's how you can pretty much see if there's value there to be had, because at some point, most of them will stabilize back to their baseline. So just, I see someone sharing links. Good. Guys are making money. I love it. All right, let's continue. That's strategy number 2. All right.
Sorry.
All right. Are we going up?
No, my computer froze a little bit. 1 second.
There we go.
There we go.
Ooh, that's sweet. All right. So actually, investment strategy number 4 goes back to the Fundrise thing, and would have been a good natural extension to do here. But this here is more. As a matter of fact, Nat, can you just go down to 4, and we'll take 3 last, because go down here. Right. Boom. Because someone asked, and let's take that, and we'll jump back to 3. All right, investment strategy here, real estate crowdfunding. Now, just to give you a backstory on crowdfunding, crowdfunding was typically associated with Kickstarter, people that have cool products, and they're like, hey, donate money to us. But in reality, crowdfunding is what the concept of the stock exchange was. A company that's performing, they need additional funds, liquidity. They're allowing the opportunity for people to buy in. They get more cash in their books. They can go out and pursue new opportunities. They can operate better. They can optimize things of that nature, and allows people to come in. And that's how the basis of the stock exchanges started. I believe the first one was the first company to publicly list its shares. I believe it was some sort of Dutch shipping company of some sort. Anyway, you don't quote me on that. But that's how it worked back then. Now, in 2012, as this continued and the more sophisticated investors amassed all the wealth, hence the 1%, it created a situation where the 99% was sort of out. Now, a large part of the 99% were still investing in stocks, but still they still needed to work. And they still needed to have retirement setups to protect them. There wasn't real wealth accumulated, right? So in 2012, President Obama signed something into effect called the Jobs Act. And what that did was it allowed companies to issue securities. Remember, securities like the stock or a bond, all right? While these things were done privately, there was a barrier to entry where you have to be what's called an accredited investor. You have to make $200,000. You have to make $200,000 a year, or you have to have $1 million net worth, not including your house. So basically, you got to have assets that you've accumulated. How many people really have that? Not a lot. Maybe 90% of people don't have that, right? So he signed that into effect to allow what's called retail investors, basically non-professional investors, to get in and get a piece of these. Remember, we talked about illiquid investments. They have the high returns. Uber, Facebook, all those things, you got the high returns before they became publicly available. You know, it's like once they IPO'd, yes, you could take part in the party, but the fun part had already began with a closed-off circle of people. You get what I'm saying? So that's what real estate, that's the inception of real estate crowdfunding. Now, the term has become conflated and confused with the Kickstarter thing, but in reality, what it is it allows people to buy into real estate assets. And it really took off. The first one to hit the market was, I'm giving you guys history lessons here. The first, what I feel like is important to share, was Fundrise. And they hit the market when they took the World Trade Center, which is, Vinny took the old World Trade Center, man, in the picture. Anyway, so they issued, because the World Trade Center was redeveloping. So they issued bonds, and they came out and said for $5,000, anybody could invest in the World Trade Center, right? So that's how they came out, and it became popularized, and it allowed people to buy into these projects. Then they came on with other buildings, and they created a product called the E-REIT, like a E-check, E-this, E-that. So to the question before about is Fundrise a REIT, Fundrise is essentially a tech-enabled private equity company that takes investments that are illiquid in nature. Sometimes they may pay you a dividend, sometimes they may not, depending on the type of investment. They have different products that can pay you, but the idea is once the lockup period is over, you get your principal back, you get your return back, and in some cases you get that and that plus the dividends on a recurring basis. Myself personally, and I don't know if I should share this. Well, I will anyway. Myself and my father were invested with a company like that in Denmark, where it was specifically like this into a building where we had what's called 10 LPs. That means limited partners, basically means investors, but through a tech-enabled platform. So there's 10 owners. The manager owns 10%, but controls everything, right? And then the rest of us, we have a share each, and myself and my dad have a share in that building. It's a similar concept to that. So real estate crowdfunding is essentially a way where buildings can issue shares and allow people to buy into them. So there's a number of these. There's actually one that's not included here that I personally like, but the reason I didn't include it is because it's not less than $1,000. It's more like 10,000, 20,000. They have tremendous offerings, and once you quote unquote graduate from this, that's a good place to look. But Fundrise is one. They have $500. They have a very popular. They have several E-REITs, Growth REIT, I believe one is called. Well, they have different E-REITs. Realty Mogul is sort of the number 2 in that space. They offer something similar. They have something called a Mogul REIT. Now, in terms of that, you asked me before, are they REITs? Here's the thing. Again, REITs by law required to pay out 90% of dividends, right? In the fine print, it said they call it Mogul REIT LLC, I believe it was called, but it wasn't technically a REIT. It functioned similar to a REIT, but without the tax implications of a REIT. Instead, they may convert to a REIT in the future, which is why it's like, it's a tough question to answer directly because it all depends on the one. But the idea is that you're going into an illiquid investment. And some of these have what's called returns, right? Preferred returns. Let's say there's a preferred return of 8%. Some people think that means you have to get paid an annual dividend of 8%. And then some people will go, wait a minute, I'm not getting paid. Well, you're technically not supposed to be paid until the lockup period is over. The deal we have, to use an example, we have a preferred return of 8%, and they pay out 4% in dividends, which is half of our 8%, and that half comes later. Make sense? So that's just one thing you must understand about these things. That you may not necessarily see instant money coming back, but you can track where it's going. But that's the whole benefit of like the founder of Fundrise said in the interview, you have to pay a premium for liquidity. If you want to be able to pull your money out, you're not able to get those same type of returns from the billionaire blueprint. So that's one such example. I would be careful. I don't want to appear as though I'm giving investment advice, but I think this is a good one to try also. Again, treat it as tuition tax. Those are the ones. Then you have Republic, which just acquired something called Compound. What they were doing was something called REITs, like a hybrid of REITs and ETFs, but they were selling shares in condos. So those are the ones, and that goes as low as $100. So those are the options there. And those are a form of securities. So these are the ones where you just hands off, put your money in, learn the business, see how it's, someone's asking what's tuition tax. Tuition tax is just it's just a terminology I use to factor into your investment that you don't know what you don't know. And if it turns out you don't have to pay tuition tax, that's a bonus. All right, make sense? All right, now, any questions here? Any questions for this? Let's see if we can take it.
We'll move on. Please stop sharing the Robinhood links in the chat box. You have more than enough.
Yeah, it's enough for now.
Okay, we're just gonna go back to slide.
Now, do we have any questions with the crowdfunding item? I saw there were some questions.
I'm not seeing anything. The 10K app that you mentioned, someone's asking.
Oh, it's not an app. It's called crowdstreet.com. Crowdstreet.com. And in fact, what I would like, let's stay on crowdfunding for a while now.
Okay.
Yes, let's stay on that because I feel as though that's just that whole illiquid thing. I'd love to explain that. So take any questions there. But it's called crowdstreet.com. And even if you sign up, you can look at projects. You can see the different terminologies will start to make sense to you. They are using the metric that they typically use to basically means annualized return on investments. They use IRR. It means internal rate of return. It just factors in appreciation plus cash flow. Because cash flow is one such metric, cash yield basically. Then you have appreciation, which means, what are you getting back? Your return on investment. And this just factors in both things. So just browsing those will teach you a lot. So any questions here?
How do you decide on what to invest in?
You always want to look at track record. Have they done this before? This is a simple philosophy I use. Don't invest in ideas, invest in systems. All right? An idea is just something, because think about this for a second. Somebody could have the best idea in the world. Somebody could have the best deal in the world. But if they have not gone through the process, the emotional ebb and flow, oh my God, is this deal going to close? How do I get financing? Oh, these contractors aren't showing up today. If you haven't gone through that process, you don't know how to react to them. It's kind of like, that's why when you start driving, you have somebody next to you because you don't know what could potentially happen. So there's somebody there that's experienced. Even I do this myself. When I do new deals in a new market, I make sure I have somebody, even if I'm driving, I make sure I have like the best driving teacher in the world next to me. Even if the most talented driver in the world, and even if I were to go to the UK right now where they drive on the left side, I would not drive unless I had somebody that knew what they were doing. Even though I could probably figure it out, but you wouldn't take that chance with your life, so don't take the chance with the money. Poor analogy, but you get what I'm saying. So yes, you would look into the track record, look in what kind of projects have they done before. It's just some sort of, wow, this is a fantastic idea. I like simplicity. I got a message today from a young real estate investor. He's always hitting me up with these most absurd projects. They're so wild. They're like they're goofy. Like, yeah, the Queen of England is about to default on this, and she's selling out 37% of her castle, and we can get the money back in 7 years if she has 3 grandchildren. Like absurd. I'm exaggerating here, but just giving you an example. Once it gets into that territory, then it's too much. You just got to see the clear path to the money. So, like for instance, with the developments that we do, Temple University, for instance, I look at this. Since 2013 up until now, every single year they're setting application and enrollment records, and they're climbing in terms of rankings. That lets me know there's going to be a constant, and also college as a business model that's not going to go out of education, is not going to go out of style anytime soon, simply because parents, it's just something they do for their children. And it just seems to be the way you have to go in order to get a job. So it's not going to go out of style anytime soon. So I just look at increased demand. Then you look at numbers like 90% aren't live off campus. So that's a no-brainer because there's constant demand. It's easy to see the pathway to the money. New York City, 65% renters, stuff like that. If you go to a market where there's lots of jobs, more people are moving there, then it makes sense to have apartment buildings. See, so that's how you can look at that. If somebody puts up a project, if somebody puts up, yeah, I got this great hotel project, it's in a great residential area where there's no people. That doesn't make much sense.
There's a question on here. Does crowdfunding also offer fractional shares?
It's not like a system like that. It's really just private money managers or real estate developers that are offering private people to buy in with technology, and it's governed by and regulated by the SEC. So the SEC comes in and vets it and makes sure they have to approve it. Is to prevent like dastardly things. Even with crypto, which isn't crowdfunding per se, they had this thing called ICOs, initial coin offerings, where it just happened so quickly with crypto. People came in and it wasn't really regulated soon enough, and it was a lot of nonsense that was happening there. But in terms of fractional shares, it really depends, I guess, on the issuer, but I don't believe so. 500 is the minimum here. If it's Fundrise and Realty Mogul specifically, 500 is the minimum. So I'm saying downsides of, any other questions here?
Yeah, does crowdfunding require a professional to manage it?
Yeah, I would say so. It yes, not always necessarily, but that's part of the due diligence. You want to make sure what's the track record here. What's the track record? So, but again, Fundrise, Realty Mogul, they do have that, and you can just look into that. There are tons of them. There's I don't want to go into details, but it's always good to, you guys remember when they had like sneakers, like you want the Air Jordans or the Air Max, and then they have this thing, like these new things, you don't know what the heck they are. You won't take a chance on those. I know I wouldn't. So stuff like that. So, but anyway, so I just kind of like any more questions in terms of real estate securities, REITs, mutual funds, tech-enabled private equity, which is essentially real estate crowdfunding. Any other questions with that?
No, we can go back.
So let's move up to strategy 4. And this is one that I really like because, echo up. Here we go. Investment strategy, tenancy in common. This one I think is the interesting one because that one puts the power into your hands. Now, sometimes if you don't know what you're doing, it's good to put the power into the hands of someone who does, right? But like we were talking about last week, a way that you can live rent-free while owning an asset, owning a property and learning how to manage it and run it and so on and so forth. This here is an extension of that. And that's why I kind of want to end with this before we go into taking questions. Tenancy in common, TIC. That's just the, Wall Street loves to use these acronyms and terminologies. It basically means buying property with other people. It's confusing more than it necessarily has to be, right? So what this means is it's a structure where multiple people own a property together. Does it make sense? So let's see this scenario right here. We have 3 people. Can you scroll down? We can go back up to this one because I want to show you where you can find these. Let's say $1,000, because again, the theme of this is someone saying a timeshare. No, not a timeshare per se, because you go there and you use it and this and that. It's more like co-ownership, right? It's essentially a form of private equity. Remember the scenario I gave you guys where there's 10 of us that own an apartment building. I believe it has 88 apartments. There's 10 of us that own that. So this here is a miniature version of that, but it's the same type of thing. Look, you could add zeros to the number, to the percentage can remain fixed, if you will, but take 1,000. If you put that at 1 million, then you put an additional, then that's 80 million, right? Put in the additional 3 zeros. That's how the math works. That's a lot of times when you see, actually, fun fact, when you go and look at balance sheets, you see in thousands. It'll say in thousands. The number, it could say like 80,000. It really means 80 million. because it's expressed in thousands. It's the accounting speak. All right, so let's use the $1,000 example because that's the theme of what we're doing. Times 3.5% down payment, $80,000 property. There are properties all over the country. Again, I would recommend that you go where that you invest. You go where you can go, or you go where you know. Like, you know the neighborhood, you know all the dynamics, you've lived there, something like that. You have somebody who lives there. But now, just this example here, you can, let's say, a duplex in Florida, or a 3-family property in Atlanta, something like that. This is what the math could look like if we were to use let's use the FHA calculation here. Then 3 people put down $1,000 each as a down payment. You buy that property, you rent it out just like you would do if you were by yourself, or if you were to buy the property with a significant other and you live in one unit. That's the same thing. That's the setup. If you buy something with a significant other, that's the setup. If you have 3 people, same thing. All right, so that's just what that means. It's a way to leverage your individual equity collectively to have an asset. Now, granted, you got to have rock solid agreements in place. You got to have an understanding before you go into that. So that's what that is. So let's go up that. I want to show where people can actually find them. Then I want to take questions on that. Someone said, do you have to live in the property? In this example, the FHA, yes, but just don't get too caught up in the down payment percentage. If it's 20% down, right? Then it's just a conventional mortgage. There are certain mortgages right now that are available because they lowered interest rates to get more money into the economy. So you have, in spite of what you may think, you actually have quite a bit of leverage when it comes to going out and negotiating with the banks. As counterintuitive as it sounds, but so just don't get too caught up in the particular specifics. You can have 5 people, 6 people. You can put more than $1,000, but we just use $1,000 for the sake of the theme of what we're doing right now. Now, let's look to the right here, because some people are wondering, where do I find these properties? My favorite one is Trulia. Trulia, Zillow, same company. That's where you can find them. But there's a lot of, everything is there, like land, condos, junky houses, which may be what you want to do, because you can, this whole thing, the co-owning works with a flip also, which is it's a very common structure. You guys heard when we raise money from friends and family, that's a scenario that's sort of like a hybrid of tech and crowdfunding without the technology. A lot of this is really just fancy words to express the same thing. Are you investing alone, or are you investing with other people? If you invest with other people, you can get more and you can grow faster. That's really all it is. You're doing it by yourself, you're doing it alone. It's kind of like if you build something or a school project, if you're doing it by yourself or you're doing it with other people, it's the same thing. Now, Trulia is what you see. Redfin is personally my favorite for FHA, simply because the interface is nice and neat. You type in a zip code and you can click in the filter to put multifamily. You can put the price tag, it spits it out. It's really quick. So that's what I like. LoopNet, on the other hand, that is the platform for commercial properties. All right. So someone said, do all the partners have to live on no, and don't get too caught up in that. You don't have to live there at all, depending on what type of loan you get. Anyways, so LoopNet is where you find commercial properties. This is typically anywhere from 5 units and up are considered a commercial property. Like, and you go, commercial property, that sounds like an office building or retail. How is that residential? The reason is a residential building with multiple units are considered that is because, considered commercial, is because it's a building for the purpose of making money. It's not a place that you live and then rent out other pieces to other people. It is a building for the purpose of generating money for you. It's a business. Hence commercial, right? So LoopNet, what it has filters where you can actually, that said, it has 3-4 family properties where you can go in and find stuff that actually would qualify for FHA. You can go in and look, you can put the same thing. There's a little more, I won't use the word sophisticated, but it has, it's a little more advanced. It's definitely entry-level grad school type stuff versus just being senior level in undergrad, if that makes sense. Now you can type in what type of property. You can put multifamily, or you can put one that's, forget what it's called, income producing or cash flowing. There's one of those where you can find some that already has tenants, and you can look into it and you can see what the price is. And it's actually quite interesting to look into, because if you put you can just put a max price point, let's use $100,000, and you see what come up in the entire country, and you'd be shocked what type of real estate is actually available throughout this country. You know, it's really fascinating. And LoopNet, what is right there, loopnet.com, and I would encourage you guys to go check that out, because you'll see. But that's where you can find these properties, and you can go do this type of thing here. And it's very common. Lawyers will know how to put this together. It's a very straightforward thing. And a lot of times there has to be somebody who will qualify for the loan, who has to sign on the loan. And whatever deal arrangement you want to have privately on the ownership is entirely up to you. The bank just says, does this person make enough money? Does this asset generate more money? One of the people, matter of fact, one of the people on our team had bought a 2-family property, was pre-qualified for, I think it was 350. I don't know if she's here. She can, maybe it was 400. She ran the numbers, showed how, well, this property will generate this much based on this ABC. She got an additional $50,000 in buying power. It's like, okay, this property can support this type of loan. All right, go for it. Again, keep in mind, it's human beings that are making these decisions. So, and the more money they put out there, the more they make money, not from foreclosing on you. They make more money on money going out, interest payments. That's their business model. So it's in their best interest to go place as many loans as they possibly can. So yes, guys, any questions on this here? And then we can start going to general questions.
Can you just put in?
Say that again?
What's the cap rate?
Ah, beautiful. Cap rate. Can you guys see me? Let me pull out a. Cap rate is the metric that people look at to see, is this a good investment? A lot of people say, is 10% a good cap rate? Well, it depends. It depends on the market. In New York, it's excellent. If it's in the woods of Montana, not so much, because you can't rent it out. So the way you calculate that is NOI. Holy cow.
Oh,
NOI. I hope you guys can see it.
No, it's too small, Philip.
Is it? Okay, all right. So take notes. I'm going to put it. NOI, net operating income. That basically means, what do you have left over of your rent money once you've paid maintenance and your tax, everything? Once you pay all the expenses that come with running a property, once you've paid that, the money that's left is called NOI, net operating income. Basically, your net income from operations, net operating income. Now, that would be in your financials. So when you look at a property, then you look at what's the price. So if you divide the NOI with the price, that's your cap rate. So that's a way you can look at, wait a minute, is this a good deal? Because you look at what's the average cap rate for the yield for this market. So if you ever watch this movie, The Banker, which is a really great movie, I would encourage you guys to watch it. It's about two black guys in the 60s that were looking to get into real estate, and they were being given a raw deal. They were trying to, for another deal, they had done a couple of deals, and then they couldn't get a loan from this one bank, and it was in a commercial building in downtown LA. So they got mad and said, let's buy this building. Then they can't tell us no on loans now, can they? So and they talk about cap rate quite a bit. And so I think that's interesting. But if you look at that, so one of the things you want to look at, okay, if something is priced a certain way, let's say $400,000, whatever, I'm just throwing out a number. And you go, well, the cap rate on that $400K is 5%. I only want to pay a cap rate of 7% for this market, because, again, a lot of times you look at the profitability of a deal is the cap rate, which is the yield. What do you pay? How much is going to make your net income against your price? Let's say it's 10% of that, but your cost of financing is 7%. Then you have what's called a 3-point spread. Does it make sense? 7% you pay the bank, 10% you get from your building, 3% you get to keep. If the cost of capital is higher than the cap rate, you're losing money. Meaning the interest payments to the bank, if that's higher than your debt payments, your interest, then you're losing money. So that's just how cap rates work, is to see what's the going in yield, how much money you're gonna make from a cash flow standpoint. And you say, look, I only wanna pay a 7 cap, that's the jargon, a 7 cap on this property, not a 5 cap. That means the price will go down, and then you look at what's the NOI divided by what 7% is, and that's how you find what you want to pay for. So that's how you use a cap rate. I understand this is high level. Make sure you shoot your questions, but does that make sense? It's basically The money you have after expenses divided by price, that's your cap rate. And the cap rate is a number you use to see, is this a good deal or a bad deal? So when you go to an agent, you say, hey, I want a 4-family property with a 10% cap rate. They know exactly what to find for you. All right? So let's see, because what are some other questions now?
There's a lot coming in. Hold on.
All right. Let's see if we need to clarify some of the stuff that I said right here.
Yeah.
I'd love to break it down. We can put this up here to see if it helps visually.
Someone's asking, why would you want a lower cap rate?
You wouldn't. You typically wouldn't. You want to sell at a lower cap rate. Exactly.
Okay. Yeah.
Let's keep them coming.
Are there 3? We're going back to crowdfunding.
It's fine. Let's just.
Okay. Are there 3 companies in the crowdfunding you presented that are managed by professionals?
Okay. Realty Mogul and Fundrise both operate their own projects. They don't list other people's projects. CrowdStreet, they're just a marketplace for pre-vetted developers. And Republic is the same thing. That have been vetted, the project has been vetted. They put it on there, and then on top of them vetting it, you can do your due diligence and see if it fits your investment criteria. Whenever you invest in something, it has to be something, I always say, invest in stuff that you understand. If someone brings to me, I approach anything in life really like I'm an idiot. Truly, like I'm an idiot. I just assume that I'm an idiot, unless it's something I understand. And by sticking to something that I understand, I can make sound decisions. But it's something that just skews just a little bit from what I understand, I totally dismiss it, unless there's an incentive for me to understand. Does that make sense? So yes, to answer the question, Fundrise and Realty Mogul, they manage their own projects. There are others out there that just list other people's projects, call it OPP. And then you have hybrids. Some that, yes, they raise money for their own projects and just team up with people.
Here's another question. For investors 60 years and older, is it okay to pull from your retirement plan to fund a real estate deal?
That's something you should just, for 16?
60.
Oh, 16, I say you need to talk to your parents. 60, and right now it's, with the CARES Act during the pandemic, they were trying to find ways where people can go out and use their money that's usually locked up. Again, it depends on the project. It depends on your risk tolerance. It depends on your reason for doing it. One of the things, I'll tell you this one thing that I learned. When I started, so in 2017 is when I reached that point where, where it was doing well, right? And I started getting introduced by my bank. There's something, so I was with Chase, and then you get with JP Morgan, graduate to JP Morgan type of thing. And they explained certain things to me, and they showed me, and this is a real true, this is a true story. They showed me a person that had $1 million just sitting there, and another person that had $100 million just sitting there. So I'm like, that makes no sense to me. Why would you have that much cash? I don't believe in having a lot of cash at hand, because it just, inflation is going to eat it up. If you're a young person, I'm relatively young, and still a young human being. You probably don't have the, especially if you just started, if you're just now starting to make money, you probably don't have the maturity to handle it. Exhibit A, athletes, entertainers, you know, it's very emotionally difficult to stay disciplined with that level of liquidity. So I saw it and I said, why would they have it just sitting there? Why wouldn't they take that 100 million and turn it into $1 billion? And he explained to me, because there's a person, this is someone in the Upper East Side that's retired. They got that money in municipal bonds that's paying 5% tax-free every year. That's on 100 million, that's literally a fortune. Investment horizons, the billionaire blueprint, is typically 7 to 10 years. So you can just do the math. If your 15% return doubles your money in 4 years, 10 years, like, people are getting spectacular returns. Then it's no longer percentage returns. They're talking what's called equity multiples, right? Now it's not 50% return. It's like 2x, 3x, 4x, 5x, meaning 5 times, right? So I said, wow, that's what they're doing. So to answer that question, a 60-year-old depends. What's the yield you're getting on your money now? And is it just a situation? Do you want to spend 10 years with an aggressive investment strategy? You could, yes, but it's entirely up to you what your goals are and what your risks. I don't want to come across as though I'm advising. I'm just saying there's different things to consider depending where you are in life. Someone like myself, I don't have a need for a lot of liquidity, so I could just put that to work, you know? But it's different. If I had children and grandchildren, it's a different story. Does it make sense?
Yeah, I think so.
Mm-hmm.
Are we done with the presentation?
I mean, we can say, we can take pictures, not pictures, questions, and
okay. So I'm going to stop sharing.
Let's just keep it there because we can always scroll up and down. I think it's fine.
Well, people can't see you. That's why they're asking if we can stop sharing it.
Oh, they can't see me.
Yeah, you're a tiny box.
Oh, that's fine. They say they can see me. It's fine. Let's continue because I'd like to use visuals. So, what other questions happen? He said he's in his tiny box. That's fine. I don't need to be all of it.
What's a good number of multifamily properties to start with an investment? To start as an investment? Just one. There you go.
Can I get the chat transcript? No. No, I mean, one is a good place to start. You start with one, accumulate small wins, don't get greedy. There's this, oh my God, I hate to sound nerdy, but there's like this philosophical cognitive paradigm that I sort of use to assess other people. Like I've developed over time the ability, I can spot somebody where they're going to be in 5 years, how successful they're going to be with what they're doing. It's just, and one of the reasons is the ones that are really, really successful is they put themselves in uncomfortable situations where they have to learn and figure stuff out. And if you're someone who will figure stuff out, you'll be successful, but it's always one step ahead. It's one step ahead of uncomfort, discomfort, unknown. If you go 2 steps ahead, example, let's say you have an ability to raise a lot of capital and you make people invest in an idea, but you're somebody who figured out, you're gonna have some bumps and bruises along the way simply because you're gonna pay that tuition tax. That's what I call 2 steps. When you go beyond that is, let's say you have an ability to raise capital, but you've done well with some deals. So you've now created a system that can scale other people's investments. That has a far greater probability of being successful. But a lot of people will look too far ahead because they'll see the upside, the carrot, you know, and they won't pick the low hanging fruit. You get what I'm saying? So I would say start with one small, then go with one that's a little bit bigger. And it just like, it should build slow momentum. So that's what I would say.
Another question, this is a good question. For beginners who know nothing about investing, what's a good book to start reading to learn about investing?
There's a couple. I have a couple, actually. There's one that I like. There's 2, as a matter of fact, by this author called Keith Cameron Smith. All right, Keith Cameron Smith. And one is called The Top 10 Distinctions Between Winners and Whiners. Both of them are like an hour read. And I bought that book back in 2011, and I would let people hold on to it. They would never give it back. And to this day, myself and Martin, my co-founder, and my nephew, who's like the famous soccer millionaire, he still carries it, or he always carries a book bag around. And so do I. If you see me anywhere, I'm usually on my e-scooter with a book bag, and I always have a book with me. And one of those is that book. Now because I got tired of not getting it back, I got a digital version. So if you guys want, Nat, can we send that out? No, I don't know if I'm allowed to.
I don't think so.
No, okay, yeah, you gotta go buy it. No, I can't do that. Yeah. Jeez. It's cheap anyway. It's an hour read, top 10 distinctions between winners and whiners. And again, it teaches some sound principles, a lot of things that people know consciously but don't apply and live by unconsciously and subconsciously. Is basically accountability. The cool thing about accountability is that it lets you know that you can do whatever the heck you want to in life, that nothing's impossible. The scary thing about that is that it removes every semblance of excuse, which can be scary because there's nobody to blame but you. That's what I love about that book. Great place to start. He has another book called Top 10 Distinctions Between Millionaires and the Middle Class. Love that book because it explains, again, we spoke about this last week, right? Somebody who makes $1 million from one income stream versus somebody who has 7 income streams and makes 100,000. That's a wealthy person. This person can lose their job and they're screwed. They're living paycheck to paycheck. It may not seem like it, but they're living paycheck to paycheck. It's just a hefty paycheck, but still. So it shows the middle class mindset versus the wealthy mindset. One of them is people, quote unquote, non-rich people live day to day. Middle class live check to check, which is month to month. And the billionaires live decade to decade. So sound principles in there, easy to digest, can always go back to and read it. Rich Dad, Poor Dad is another one that I recommend. It just breaks down leverage. It breaks down the concepts that we discuss here. It makes everything palatable, digestible. It's just easy to go back to, and it shows how money can work for you versus you working for money. What's another book? Those three are good, I would say.
Okay. Is there a good search tool to find multi-units?
Yes. Redfin and LoopNet. The ones that you see here, the ones that you saw here. Redfin, isn't that what a fish has? And redfin.com. Just like that. All right. Yeah, somebody put it in there. Let's take a few more. I think we're running out of time.
Yeah.
What's a few more?
The next one is, how much return or dividend can you really get from a $5 REIT? Can you build a wealth with that?
No.
Of course not.
Makes common sense. But the $5 will teach you. And if you start with $5, then you start putting in $5 a week, and it turns into 50 a month or whatever. And you're starting to, what that does is teaches you money without you having to. The cool thing I think about learning by doing is that because you don't know what you're doing, you're just learning by doing, you're not becoming intimidated with the information. A lot of times it's because it looks so crazy and scary and it intimidates us. And unconsciously, we're like, we don't even accept the information because we just feel like we can't. You know, like I used to read the Danish version of the Wall Street Journal. I would try and read it. I remember I was like 18, 19. My dad would read it. And I would try and read it. I didn't understand any of it. Then I would try. I would really make an attempt. And then slowly but surely, I'm like, oh, I'm just a teenager. I'm not supposed to know this stuff anyway. This is boring. I just throw it away and I wouldn't read it. So the best way is learning by doing. And when you have those apps, you put that in, it just sets the process in motion for you to understand what's happening. And if you, at the same time, which, you know, and this should be straightforward for you guys, is to just get into the habit of then same process with saving, putting it into investments. And then that can become your starting point. You got to start where you are. So the $5 can never become $1 million on its own. Just doesn't work like that. But it can allow you to put the next $5, the next $5, you know. So yes, next question.
What's a typical payout period with crowdfunding?
Remember, it's something new. So it's not necessarily that crowdfunding it all depends on the offering. A better reference point I could say is like with private equity deals, anywhere from 5 to 7 years. If you're a like I call a matman, like somebody's a professional investor, 7 to 10 years. Remember this thing in the book, middle class versus millionaires. It shows that people think decade to decade. And once you get into that type of thinking, you don't make rash short-term decisions and you start to evaluate things differently because like, wait a minute. There's this thing Mark Zuckerberg said when he was growing Facebook, right? People would come with ideas that were getting that early traction and people would think, you should sell it to Yahoo for $1 billion. Like, no, I have this vision up here. And people were mad at him because there were people who were going to get paid out in stock and this and that, like, because they were thinking, I'm going to get $1 million if he sells, like I'm not doing it. And then shortly after, he took an investment that was much larger than that valued the company like $15 billion. But he said, what he would say is, what we're doing right now, does it help user growth? It's like this guy said, well, let's start these new products. I'm like, does it help user growth? Like just having your eye on the prize, like, does it help this large goal? If it doesn't, don't do it. So to answer that question directly, there's no set thing in terms of what crowdfunding pays out. Is just on the individual deal-to-deal basis. You can invest in a fund or you can invest in a deal, like an actual real estate project. Real estate projects may have a shorter time horizon than a fund does. So fund can have like a 7-year life. you know? So it all depends, but it's all different. It's all different.
I think this is a popular question. Should you invest in real estate and use it for Airbnb?
God, that's on my eye. Right now, I wouldn't say so. For me personally, I tried that, and I could see that there's stuff there. It just doesn't work for my temperament. It was the whatever premium I can get against the rent. Let's say you get $1,500 in rent from doing this, and you can get a potential $2,500. You look at the numbers like, oh, it's an extra $1,000. All right, what did it take for you to earn that extra $1,000? For me, it wasn't worth it for a number of reasons. It would take me away from larger But you ever heard the saying where, are you doing $20 hour tasks or you're doing your $5,000 hour tasks? Figure out where you drive the most value from what you're doing. If Airbnb, if you're service minded, you're really good at that stuff, boom. In this climate right now, I wouldn't do it simply because there's no traveling going on. So where are the people going to come from? There may still be demand, but it's probably not the best time. So as an entry level strategy for Airbnb, let's put it this way. Someone sent me an Airbnb play. I immediately deleted it. Like I was like, this is just what I said. I was like, this is beyond brain dead. Right now, in the middle of a pandemic, who's traveling? Doesn't make sense. But it could, outside of that, it just falls under the hospitality category, and this is what you're good at and you like to do, then I would do it.
Okay. I'm trying to keep up these questions. 1 second.
Let's take a few more.
Yeah. We need to.
Are you guys enjoying this? Is this helpful? Yes? This is good? Okay, good. Very helpful. Okay, wonderful. There will be a replay available, so you can always go back and look for reference. And on my IG, I put a lot of this stuff out. So in short videos, so can always go back to that. And I try to be as responsive as possible. So someone said, I saw this comment like ERST, meaning Empire State Building has lost money. Obviously, it's an office building. They're losing money right now. So, did you guys know that half of the Empire State Building at one point was owned? This is how once you have leverage, you can actually, you guys heard of like buy real estate with no money down? Forget that. Is it real? Yes. Do you need to have experience and the sophistication to actually see where those opportunities exist? Yes, you do. And it comes with the experience. But the guy who's the president right now, at one point in time, he owned half of the Empire State Building without having to put in any of his money. Can you imagine that? Just because of what his brand was at the time for real estate, it embodied luxury real estate, and celebrities were buying his stuff, so they had a benefit from giving him half of the property. So he owned half of that at one point. That's crazy, but that's one such way. A lot of times you'll have something you bring to the table that can allow you to get ownership. A friend of mine, as a matter of fact, wants to get into real estate. He's a contractor. I said, look, instead of you blowing all these big checks you're getting, why don't you just take what's needed to pay your people enough to pay yourself for 3 months and say, I don't want to get that paid. I want to get paid in equity. Like Beyonce says, pay me in equity. Yeah, do that. Now you got a piece of these properties and you have something to pass to your children. So.
Oh.
Yeah. All right. What are some questions?
The questions are moving too fast for me to keep up.
Okay, let me see. I'll go and look and we'll do one. All right. Most lenders, Alicia Milton says, most lenders require 20 to 30% down. How do you get past that? There are private lenders that charge a little more on the interest side that will give you higher leverage. If you're going the FHA route, they'll give you nearly 97% of the financing. So, yeah. Oh, someone's asking, what's my Instagram page name? YFWT. Is it on my, no. Wealth Lab was on there. YFWTB. All right. Which of the four strategies presented tonight, which one would you suggest to try first for beginners? I would say put a couple bucks into an ETF, put a couple bucks into a REIT, start there and just see what it's like, you know, and then you'll start to learn. That's what I would say. Is it a good time to buy Empire State Realty Trust? That's not the point I'm making. I'm just saying it's available for that price. If you have $7 to spare and you feel as though that $7 will teach you, then that's a decision that you can make for yourself. How do you know if the cap rate is a good or a bad deal? Okay. Well, I hope people are enjoying it. We're going over time a little bit. how we know it's a good or a bad deal? You just look simply, what's the average cap rate for the market? Number one, you want to make sure your cap rate exceeds your cost of capital, right? If you're paying 5% in interest, you want to make sure your cap rate, your yield, the money you bring in should exceed the money that goes out. Common sense. If you sell t-shirts for $25, you want to make sure that you're paying less than $25 for that, because what you pay and what you sell it for, that's you, right? So same thing with the cap rate. You want to look at one, what is it for the market? Now, if you're buying it, a property I bought, let me give you a perfect example. It was a Class C property. Class C is just a euphemism for a piece of ish property. Very bad shape. Like our guy Vinny likes to say, bad condition. I looked at it differently because it was like a 6% cap rate, which was low. So no one was really looking at it at that price. So they were bidding lower. What we did was, number one, we got a discount because we paid for it cash. That's number one. Number two, we were going to turn, it was a store, it was a bodega on the ground floor and two-bedroom apartments on the floors above it, right? We're going to turn those two into 4 one-bedroom apartments, which means we increase what's called a rent roll, the potential revenue, which then turned the cap rate into something like 9 or 10, because we figured out a way to do something to the asset, meaning the building, where it can generate more money. So the guy that sold it made out like a bandit. He did great on the deal because he paid like $300 for it. We paid like more than that. So he made out great selling at that cap rate. We bought it at a cap rate that would make more sense for us. You get what I'm saying? So you just got to look at the deal individually. Any suggestions for Canadians? These concepts are universal. You have REITs in Canada, you have ETFs and mutual funds in Canada, and you can buy property in Canada. So it is all universal. Yeah. If you own your home, this is someone asking me privately, Penny. If you own your home, no mortgage, is it wise to pull funds from that asset to invest? That's a tough question, but yes. This is how I can say it. I would personally do that because now I have a piggy bank that I can go out and buy 3-4 properties with. Use each, let's say your home is, you have $1 million, all right? And you want to keep your home lowly leveraged. Let's say you take out 300,000 from that, 100K here, boom, boom, boom. 3 properties as a down payment, where your cost of capital, meaning your loan, is less than the cash flow. So you have 3 assets making money for you while you sleep nice and blissfully, and you don't have to pay much on your house. So Penny, I would do that, but I don't know your situation. I don't know the particulars. I'm just speaking generally. I'm not giving investment advice. Pay me in equity. Are you doing any one-on-one coaching? No, it's not. Simply because Michelle, it's from Michelle Diaz. I don't do that simply because I wouldn't feel right about doing that, because what I put on my Instagram is the same thing I would tell you. So I usually tell people, just go on my Instagram. You can get the same stuff you get from me. So save your money and put that money into a property or two, whatever you would want to invest in that. I mean, I'm sure there's other people that would do that, but put that into a REIT or a mutual fund, get started. What are good indicators of a state? Wow, there's a lot of questions here. Okay, what are good indicators of a stable area for ROI? I'm not sure what that question means, but I think I understand what you're trying to say. How do you know that this is going to be a good deal? With real estate, you just got to look at, they say location, location, location. That's it. Is it close to transportation? Like, is it close to downtown, to the action? Then it's probably going to be pricey. But if it is, great. If it's not, then the next best thing is it close to public transportation to take you to downtown, right? To the center of the action. Then you got to look at, is it close to retail? Are there big name retailers around? That's usually an indicator of that this is solid. And the property that I ended up buying here were the indicators. And I assumed I was an idiot, so I asked a lot of questions. To this day, I tell my attorneys and everybody, I usually preface it with, I'm from another country. I have not seen these things before, so forgive me because I'm going to be asking 2nd and 3rd grade questions. So then I just ask everything I need to know. But again, what I did was I bought a property that was brand new, 3 apartments. It was close to transportation. That was 12 minutes from the World Trade Center. There was City Bike right outside. And there was Subway and Burger King, which again is big name retail. It's not the best. It's probably not the best, but it is there. And I saw new buildings being built. though that to me showed, okay, here, we got something here. And I was right. So turns out these are the things to look for. Are you able to utilize private money lending with the tick strategy? Yes, you are. You absolutely are. Also, does each individual's person's credit come into play with this? If you just have one person that has really good credit and really good financials, use that person. All right. Okay. All right. I'm getting orders to wrap this up. Guys, oh man, we're going to have to do something some other time with answering all these questions. I am just glad I was of help. Let me remove these. We could be here all night. Thank you guys so much for tuning in. I hope you enjoyed it. I hope this was helpful. I hope some of you guys made some money tonight, and I hope you guys are having some ideas and this, because like I always say, and I know this from firsthand experience, I always say wealth is a function of the conversations around the dinner table. Once you start having these conversations around the dinner table, this is an analogy, like with your friends or whatever, things just start to change. So thank you guys for tuning in. I hope you guys enjoyed. Time just flew. So, and I hope some of you that didn't have the Robinhood and the stash or whatever, you guys made some money and you guys have a wonderful night. A pleasure to spend this evening with you, and I'm out of here. Nat, any closing remarks from you?
Nope, that's it. I will send out an email with this recording. And if you have any questions from now until then, you can shoot me an email, and we'll do our best to get to everyone. Thank you for coming.
Peace out.